Hello, everybody. Welcome to yet another episode of Learning Perspectives. Today, we are going to deconstruct a scene from a movie called Seeta or Geeta. And the concept that we are going to learn today is about cash flows in a business.
ओफो गुप्ता जी आप तो हमेशा जिद करते हैं बेटी अपने चाचा को
क्यों? चाचा जी की गिनती गुप्ता जी की ईमानदारी से बढ़कर है। गुप्ता जी, इन्हें गिनने की कोई जरूरत नहीं, पैसे पूरे हैं।
फिर भी अगर
नहीं गुप्ता जी, हम इन्हें गिनकर आपका अपमान नहीं करना चाहते हैं।
बेटी, इस घर में मुझे 20 बरस हुए आते, आज पहली बार हुआ है कि बगैर गिने।
आजकल इस घर में बहुत सी बातें पहली बार हो रही हैं। हो रही है ना चाची?
हाँ हो रही है।
अच्छा बद्रीनाथ जी, इजाजत।
बस गुप्ता जी चल दिए?
हाँ बस चलूंगा। नमस्ते भाभी।
नमस्ते जी।
नमस्ते जी।
जीती रहो।
आइए चलिए, मैं छोड़ा आपको।
चाची
बेटी मैं कह रही थी कि
क्या कह रहे थे?
पैसा तिजोरी में संभाल के रख दो।
तिजोरी में रखोगी? लो रख दो।
मैं भी आती हूँ।
Now, the scene that you just saw showed how Geeta, she's the confident twin, was pretending to be Seeta. Now, she gets her monthly share of income from an accountant who comes every month to the house. He gives some money to Geeta in this scene, and her aunt or chachi is trying to get that money from her so that she can use it or steal it later. Now, similarly, even in businesses, there is inflow and then outflow of cash. Correct. So, one of the financial statement any company or an organization prepares is called the CFS or the cash flow statement. Now, this statement is prepared to understand the exact cash position in a company. Now, cash and cash equivalent that is present on the balance sheet does not give you the exact amount of cash that is present on a daily basis. Hence, a proper inflow and outflow of cash needs to be maintained in any kind of business. Cash in a business comes through three activities which are very important to understand. Now, inflow in business leads to increase in cash. Outflow, as the name itself is suggesting, it's going out of the business, leads to decrease in cash. Now, like I mentioned, there are three basic activities through which any organization earns money and spends money. Now, these three activities are operating income, operating activity, investing activity, and finally the financing activity. Let's discuss each of them in detail. Now, operating activity means any activity related to the operations of the company. This is the name itself is suggesting operating. Now, for example, in a restaurant, your main activity is selling food, correct? That is how you earn income. Operating activity would contain activities related to making food. So all the expenses such as buying vegetables or buying meat, buying chicken, and then cooking them. So all expenses required in cooking them, such as gas bill, electricity bill, and salary of the chef. So these are all the outflow for a firm while any sale that you make is an inflow for the company. So any income that you derive from here would be termed as operating income. And all those that are earned on daily basis would fall under this category of operating activity. Any income that you're deriving from an activity that is not part of the operations would fall under different categories of investing and financing. Now, investing activities generally relate to investing in um, fixed assets or sale of fixed assets. Now, for example, let's go back to the restaurant example itself. So, just to make my restaurant a very a good or a high earner, so I would have to invest in some certain fixed assets. So, for example, if I want to make my restaurant a very good looking restaurant, I want to have good tables, chairs, so that is furniture and fixtures, right? That I would buy. Now, this is an asset that I'm investing in. So, when I invest in such asset, this money that I've spent on furniture and fixtures, this is an outflow of money and would come under investing activity. Uh, Again, purchase and both sale. If I have to sell some fixed asset of a business, then also it would fall under investing activity itself. Now, finally comes the financing activity. Now, any business is financed through two things, either debt or equity. In this case, proceeds from issue of shares, proceeds from buyback of shares, or payment of borrowing, all these fall under the financing activity. So, all things related to either debt and equity would fall under this head. So let's take a quick example and look at Apple's cash flow statement.
Through the Apple's cash flow statement. Now, whenever we are preparing a cash flow statement, the first comes the operating activities, then the investing, and then financing. In this case, here we see the operating activities of Apple company. Now, the first step when we are doing this is we have to make some adjustments to the net income that is already given. So we can see here for September 26, 2020, net income is for Apple is $57,411 million, while for 28th September 2019, that number is $55,256 million. Now there needs to be some adjustments with regards to cash. This means that we have to make changes regarding the non-cash expenses and non-cash income. Now, non-cash expenses means those expenses that where there is no real cash involved, non-cash, right, as the name is suggesting. So if you see here, depreciation and amortization is a non-cash expense, so there has been no cash that is actually going out, but in an income statement or the P&L account we do see depreciation and amortization, correct? That means the net income had already become less from depreciation and amortization. So when we are preparing cash flow statement, we add back the depreciation and amortization. So you can see this number for 28th September 2019 is 12,547, while for 2020 it becomes 11,056. So these two numbers here are added to the net income. Now the vice versa holds true for non-cash income, because we have already added it into the net income while preparing profit and loss account. Here when we prepare the cash flow statement, we deduct it. So if you can see here, deferred income tax benefit of $215 million is being deducted from the net income. I hope this makes sense. The next thing that we need to do while calculating the operating activities cash flows is to record changes in operating assets and liabilities in the working capital. Now, what is working capital? We need to understand this. So, working capital means that money that comes in handy for the business for day to day activities, right? Technically, and in accounting, working capital's formula is current asset minus current liability. Now, here we can see account receivables, right? Now, when account receivable is, let's say, increasing, so from one period of year to the next, let's say it is increasing, so that is not a very good thing, or it is a negative thing for the business, right? For the cash flow, it's not for the business per se, but for the cash flows. Hence, in the hence increase in current asset and decrease in current liability is deducted from the operating cash flows. Okay, and vice versa holds true. um, so that would be decrease in current asset and increase in current liabilities would be added, so that we can calculate here the cash generated by operating activities. Obviously, we only see the numbers that are given here. We don't see the actual numbers of account receivable over the years, but this is the change. So here you can see changes in operating assets and liabilities. So all the here you can see account receivable is added while inventory is deducted. So and similarly you can see account payable being deducted. So finally, when we do all this, we can here then see the cash generated by operating activities. So this is how we calculate the cash generated by operating activities. I hope you have understood this.
Thank you for watching. If this video created any value in your life, please like, share, and subscribe the video. Please send this video to your friends so that it can be useful for them in understanding what a cash flow statement is. Also, don't forget to check out the links given in the comment section below. Thank you for watching. Take care. Stay healthy. Thank you.